Hello and welcome. You're joining us live for the Investor Lab, the home for passionate people seeking a life of freedom, choice, and abundance. And Gabby, how would you rate your fade today?
I'm still going. I'm still concentrating. Don't jinx it. We're getting there. We're getting there.
Hey, Gavin, nice to see you. Guys, let us know if you are here and let us know if you're here live joining us. Say hello in the chat. We love to see you here. Matthew, good to see you. Great to see so many friendly faces here again every week. We love it. We love being here with you guys.
Afternoon, folks. Hello.
Afternoon it is. I guess depends on where you are in the world. It's not afternoon for me.
Good morning, Goose.
Good morning, Gabby.
How
hey,
are
Rich.
You,
hey, Olivia. Great to see you guys. How am I? Good. You notice my bags under my eyes are less than last week. Last week, remember, I had these huge big bags under my eyes. So that's that's a win.
Should we keep track of them every week?
Yeah, we should track them. We should get some kind of measurement.
We should measure them on the screen.
Yeah.
Good. Guys, how many millimeters do we think? That's fun. That's so fun.
That sounds, let's just move on from that. That's fine. So what are we going to cover today, Gabby? Let's get stuck into it. Let's not waste any time. Let's give the people what the people want. By the way, actually, how do we know that this is what the people want?
Side quest.
Yeah, side quest. How do we know that this is what the people want? The reason we know that this is what the people want is because inside the Investor Lab community, we did a poll. We said, right, what do we want this week, guys? What is most interesting to you? I proposed a couple of different topics, and the crowd spoke. Well, the community spoke. We had a resounding 76% to 24% vote on what does New Zealand property market crash mean for Australia, which is what we're going to be talking about today. The other option was, has Sydney had its last ever property market boom?
Ooh.
Which, I think is a pretty interesting topic, but resoundingly people wanted to hear the New Zealand property market crash. And if you want to be able to have a say, if you want to be able to contribute, if you want to be able to influence the type of content that we produce on this podcast week in, week out, then I encourage you to join the Investor Lab community. It is free. It's full of really cool people. In fact, the only people that are in there are people that are genuinely committed to creating a life of freedom, choice, and abundance. They're open-minded. They're big thinkers. They're looking at everything from real estate to money to AI to, crypto, all kinds of stuff. There's great conversations happening there.
It's only you and I in there.
Well, yeah, it doesn't change any of the statements that
really
I said.
Cool people are in there. Everyone, all the cool people are in there.
But the community is not for you if you are closed-minded, if you don't want to create a life of freedom, choice, and abundance, if you are scarcity-minded, if you're negative, if you think that the world is going to end and you can do nothing about it, and you don't, all of that kind of stuff, then, not for you. But it's full of great positive people.
It is. You know what? That's an interesting point when I think about it. We won't side quest too hard here, but the negative and positive thing, we talk about very intense, like just pragmatically optimistic topics about what is happening. But I think a lot of people detect in the world right now, and particularly online, like social media is pretty rough at the moment. And there's so much negativity. Something that I really like about what we're doing in the Investor Lab community is it's trying to create this separate place away from just consuming shitloads of really negative, sensationalized content on social media that just gets served to people these days. So it's something I really like about it. Like you said, it's a really cool place to hang out, all really like-minded people. So, and yeah, we float topics for the podcast on there because we really want to just talk about what you guys want to hear about. Apparently you like to hear us.
Hang on a second. It has to fit a vector. It has to be the stuff that people want to hear about that also we want to talk about.
Oh, okay. So we shouldn't talk about cheese next week?
I like cheese. So anyway, but like
I like cheese.
Yeah. So
we can do 90 minutes on cheese.
Anyway, we're hard side questing. If you want to join the community, let's not side quest too hard. If you want to join the community, there is a link in the description or the show notes or wherever you're watching this. There'll be some text underneath it. Go into the text, find a link, join the community, see you in there. And when you get inside the community, make sure you post a welcome post to introduce yourself to the community, let them know who you are, and don't be afraid to ask questions because there is a great, helpful, friendly group of people in there. But let's get stuck into today's episode, Gabby. What the hell are we talking about today?
What are we talking about today? So
let me just go on a quick cycle. No, man, sorry.
Wow. Thank you for that. Thank you. Guys, we're talking about New Zealand property market crash. Property market decline that's been happening in New Zealand. And we're going to talk about largely because what people want to know, predominantly our audience is in Australia, Australian property investors, and really want to understand what is happening and what has been happening in New Zealand in terms of their housing market, how that has come to be basically, and how that could potentially impact Australia, and what is likely to come from that in terms of the impact on, because it's quite, we're sister nations. It's like, is it likely what happens there what will happen here, what happens here will happen there, how are they interrelated?
There's like a proximity bias and a similarity bias and all that kind of stuff, and not to offend any Kiwis, but like New Zealanders they're kind Australians, right? They're sort of like, we're very similar, right? We're very similar. And so it's natural to think, well, if they're like us, could that happen here, right? And what are the similarities? And that's really the relationship. You wouldn't have that same relationship with the UK, right? Now we could say, hey, culturally and whatever, we are similar in some ways to the UK, but New Zealand's very close, and it's very easy to be like, okay, well, what happened in their property market, and is that going to happen in our property market, and all that kind of stuff. So I think it's a relevant topic. So where do you want to start?
Yeah, cool. Yeah, I guess we could just start with what's been happening, because I think, people in our community, people who pay attention to the market may understand what's been happening in New Zealand, but in case you haven't, I just pulled this headline, which I thought was a really good place to start, and it's from the New Zealand Herald on Sunday just gone. So this isn't a housing market meltdown, it's a full-blown crash. So that was on Sunday just gone, August 17th in New Zealand. And what's really been happening, again, as a 101 of what's been happening in New Zealand in terms of housing. So in 2021, there was a peak. And pretty much since then, late 2021, a lot of places boomed through COVID. Since then, sharp, steady, strong decline in housing prices nationally in New Zealand pretty much since then. So what's that, for 4 years, basically. And rents are also declining. And so again, I think a lot of people in Australia are watching that thinking, what does that mean for us? Are we next? And so there's a lot that's gone into that situation and the result that's happened to the true pricing over there. Ghost, did you have any insights onto like how different like policies or anything have changed over in New Zealand and how that's affected pricing?
Yep. Yeah, 100%. Yeah. So there's been, well, I think there's a few things to unpack here. So I think firstly we need to unpack whether there actually has been a housing market crash or not, right? And I think that's actually a really interesting thing to dig into. But to talk about the kind of drivers, and we can kind of unpack that first part in a moment, but to talk about some of the drivers. So like Australia, they had record interest rate hikes. They went from overnight cash rate of 0.25% to 5.5% in the space of about 2 years. Yes, they started cutting rates. They also they over tightened the consumer lending policies. So they tightened up debt to income limits. They also increased the required minimum deposits to 40% in some locations, 20% speed limits in, I think, across the board. I think, don't quote me on that, but 40% in some locations and 20% in others. They removed interest deductibility for existing rentals in 2021. They changed their CGT policy. I think you had some data on that. I know they changed it.
Yeah,
they blew it out to 10 years or something?
Yeah, because it was 5 years. Like in Australia, I think it's 12 months at the moment, where if you sell a property within 12 months of buying it, then you don't get the CGT discount. And so they've got a similar thing in New Zealand where theirs was previously 5 years, and they actually extended that out to 10 years. And so obviously everything that there was this period where they implemented a lot of policies trying to bring the boom down, because as tended to happen with a lot of places through that period, affordability was really everything was really unaffordable for people. So it was a lot of general populace really wanting governments to take action to make things more affordable.
Yep.
And so all of these policies came out over a short period of time, and then correction has kind of naturally occurred as a consequence of it, and it's happened
in some places.
pretty sharply. Yeah,
in some places, right? And so they've actually, I think they've actually shortened the CGT bright line to 2 years now, as of July 2024. They also implemented a foreign buyer ban.
Yeah.
But that was in 2018, I think. So that has reduced demand. And so basically what happened was a whole bunch of changes in policies that disincentivize real estate investors. And then that caused real estate investors to seek other opportunities. And they haven't had the same demand and supply dynamics. So why don't we have a look at a couple of charts, because I think it'll kind of highlight it, and then we can kind of dig back into some of the drivers.
Cool.
So because I've got plenty.
I love that you've put more charts together.
Yeah. I've got plenty of stuff on the drivers as well, because it's some really interesting stuff. And actually, Gabby, maybe just make a mental note of it to talk about net migration as well, and capital flows from New Zealand to Australia, because that's a very interesting piece. Yep. So there's a few things we can get into here. So let's have a little look together, some slides. Okay, so this is the New Zealand national 10-year median house price, and as you can see, during the COVID period up until late 2021, there was a big boom, and that pretty much happened across the board. Lots of money printing, lots of stimulus, lots of all of that kind of stuff, and that made things extremely unaffordable. And the New Zealand property market rocketed, but this is the national median house price. Okay, so this is not everywhere. This is the aggregate average or aggregate median of everywhere in the country. So you can see it boomed up massively, and then you can see that since late 2021, early 2022, it declined by between 14 and 16%. And you can see that it has, you can see here, now this is not a mathematical trend line. I just whacked something on there to give us an indication. But you can see how far above the trend the kind of COVID spike was. Right. So there's a bit of mean reversion that's happened there, I think, as well. And you got something to say there, Gabby?
No.
Okay, cool. I just sometimes I hear you making noises. I just want to make sure you get a word in edgeways. So you can kind of so you can kind of see that, like, it was a pretty abnormal sugar high that burst the market above where it probably should have been. And so I think there's been a bit of natural mean reversion on that basis as well. And you can see over the last 5 years that prices have not over the last 5 years. So you can see that since the decline, since early 2023, prices on a national median basis have stayed basically flat, right? And so it's really interesting to me that the media is talking about it now in August 2025. They're saying, New Zealand house price crash. The house price crash, the decline happened from late 2021, early 2022 into kind of like mid 2023. That's when it really happened. So why is it that we're talking about it 2 years later? And and a big part of the reason we're talking about 2 years later is because, well, Australians love property, and if it bleeds, it leads. And so if you can create a scary story out of something to do with property, then guess what? It's going to get a lot of media attention. Oh, isn't that very exciting? But if you look at that, let's just stop for a second and just ask ourselves, if the national median house price has been flat for, let's call it 2.5 years, close to, does that constitute a crash? No. I mean, it stagnated for sure, and it did crash off its peak. It did come down off its peak by between 14 and 16%, depending on who you speak to and how you measure it. But if it's been flat for over 2 years, why are we talking about a house price crash?
Yeah, it's interesting because I look at that and I see, like, it's almost, I imagine people on the ground in New Zealand, let's say that they've gone through this correction from 2021 down to 2023, that steep phase, and then it goes flat. Like, everybody is hoping, because a majority of our wealth, I think New Zealand's similar to Australia, but like 60-ish% of Australians' wealth, and New Zealand, I assume, is in housing, right? And so people do expect this kind of like up and down, but they expect after a down for there to be an up. And so this like sideways for a couple of years, particularly when other places it's going up, they're feeling like it's a crash because they feel like it should be going up a little bit now. So it's still that
Look,
sideways.
there's an argument to say
bad.
there's an argument to say that it is a crash in in dollar terms. If they're printing more money and house prices haven't gone up,
Yeah.
then in some ways you would say that. But I would also say zoom out, like because a sideways stagnation trend after a big peak, like what happened in 2021 to 2022, I don't think that is an abnormal market behavior, right?
Yeah.
It's not like the trend is still significantly upwards. You could argue now that it's mean reverted below the mean, and now there's an opportunity for it to mean revert back up. You could argue that potentially.
Yep.
But I think that people need to zoom out, and I think it's really crazy that everyone's sitting there going, "Oh, the New Zealand property market's crashed. Oh, is that going to happen to Australia?" It's like, well, I mean, like let's just let's take a look at that. It's actually been flat for the last couple of years, and in fact,
in terms of a crash, that's not bad, is it? If you just look at the sideways line,
flat for 2.5 years, and I was going to jump ahead to Australia, but let's get to that in the end, because what is really interesting here is this is not a crash. This is flat, but this is on a national basis. If we start to dig down into some specific regions, if you look at the Auckland region, now what you'll notice from the chart pattern there is that it is the Auckland median house price graph chart pattern is fairly similar in shape and style to the national median house price. You see that? They look quite similar, right?
Yep.
Now, the reason for that is that 33% of the population of New Zealand lives in Auckland. So what we actually have, and to put that in context, in Australia, only just under 21% of the population lives in Sydney. Okay, so what we have in New Zealand is we have a very high concentration of people and capital in one specific market. And so that makes the market cap, or in fact, in two markets, I'll show you another market in a second, but that makes the market cap of Auckland disproportionately influential over the national median, right? And so what we're actually looking at here is we're looking at Auckland has had property price declines. Now, why would Auckland have property price declines? Well, probably because it got too expensive, right? Probably because, and I can dig through some stats if you want me to, but the debt to income ratios and stuff in Auckland were going through the roof. And when they put in all the policies of the minimum deposits and all of this kind of stuff, it just became untenable for people to buy there. And so they had to move up because, the house prices in Auckland were ridiculously high compared to average incomes. And so once the policy started to change, people started to move. Now, you've heard, not saying this to you, Gabby, because you know this, but if you've been listening to this channel or anything we've been saying for, the last few years, you know that there's three core drivers behind every property market, and that's jobs, lifestyle, and relative local affordability. And so what we have seen here is people moving out of Auckland to other places where there is better relative local affordability and also potentially better job opportunities, or at least better lifestyle opportunities as well. And so the other major market that has seen pretty significant declines is Wellington. Now, Wellington has 10 point, let me just double check this. 10.4% of the population live in Wellington. So between Auckland and Wellington, you've got we'll call it 44% of the population live in these two cities. So when you've got 44% of the population and subsequently 44% of broadly, you could say that 44% of the sort of the market cap of the country in these two centers, if they go down in value, that will drag down the median price overall. And so what we have seen in these two markets is because of affordability, and also in Wellington, there was a lot of job loss, a lot of public sector job loss as well, which contributed to the decline, which is why the decline in Wellington is steeper and more significant than the decline in Auckland, because Auckland has had better job opportunities, more sustainability in the job opportunities. There's been more job losses and unemployment happening in Wellington, which has caused price decline there, as well as unaffordability as well. But these are highly priced markets that have underperformed, which has then dragged down the median.
I believe there's oversupply in those areas as well recently, isn't there? Like based on, I think there was construction incentives put in place, and then there's been an oversupply of new buildings in those areas. That's kind of caught, and then lack of demand has kind of fallen away as well. So it's
I don't know. I can't speak to the oversupply because I didn't do any research into that specifically. But potentially. I know they put in a lot of incentives for builders to build new houses. But look, I don't know if you found that research, then great, awesome. I haven't. My understanding was that the policies they put in place to increase housing supply were going to take years to kind of flow through. So I don't know, but certainly people have been leaving these locations, and so to that degree, you will have vacancy rates that have gone up and all of that kind of stuff. So if we just look at Wellington and Auckland, we can see that they are both negative. Yet if we look at the national median house price, the line is flat. Now, so they're dragging things down. They are the biggest markets, and they're dragging things down. So let's take a look at a couple of other regions as well. This is the Queenstown Lakes District over the same period. So let's take a look at Wellington. Let's take a look at Auckland, and let's have a look at Queenstown Lakes District. Queenstown Lakes District has been hooning. It's been one of the best performing markets in. I'm just getting some numbers up here as well. Give me one moment.
It's hard to believe that's the same period.
Yeah, exactly. Right. So let me just I'm trying to find my. Yeah. So the Queenstown Lakes District rose 12.8% year over year to mid 2025. So just in the last 12 months, it's grown by 12.8%. Then you also have the Westland District, or the West Coast District. And again, this is straight up and to the right. So we look at these two markets, straight up and to the right, straight up and to the right. The Westland region has grown by 12.1% in the last 12 months. By the way, I don't have a graph in here, but Marlborough has also grown by 7.8% in the last 12 months. Southland District has also absolutely hooned over the last 5 years. It's slowed down a little bit over the last, it's been a little flatter over the last couple of years, but that is still upward trending price movement in those three districts. And so actually what we have here is a complete misrepresentation by the media of what is actually happening. Because what is actually happening in New Zealand is exactly what happens in Australia. It's exactly what happens everywhere. And that is that markets are dynamic, and people and capital move to where the best opportunities are, the best opportunity for jobs, lifestyle, and relative local affordability. And so people have left places like Auckland, left places like Wellington, moved their capital out of those markets, sought out more affordable locations with better lifestyle opportunities, and those markets have significantly grown. And we see that happening all of the time. We see the exact same thing happening in Australia. And in fact, this is the Australian median house price over the last 10 years. Now, I should have had a side-by-side of the Australian median house price versus the New Zealand, but let's just do a quick flick back. So this is the New Zealand 10-year median house price. You can see that it spikes and then flattens out. And then, as we've mentioned, Auckland down, Wellington down, Queenstown, Westland, Southland. These are just some examples, up and to the right. The Australian median house price. So you see the same boom period, 2021 through 2022, where it shot up. Then it dropped off a little bit, nowhere near to the same degree as New Zealand, flatlined, and then has been going straight up and to the right since. So over that same period of time, we had interest rate rises, we had all of this kind of stuff, yet we haven't had the same property market movements. You can see the same thing here over the last 5 years as well. Now,
so
go on.
So what was the difference between, why did this happen to Australia versus what happened in New Zealand?
Well, so some of the policy decisions were different. So interest rates rose, but there wasn't the same policy decisions like changing CGT rules, which again, we all know that the government's talking about doing all kinds of dumb shit, excuse my language, to tax policy at the moment. and I hope they don't. But we didn't have the same policy changes that New Zealand had. We didn't have the changes to the minimum deposits. They put a hard line on debt to income ratios. They did a whole bunch of different stuff in New Zealand, which constricted their property market. Now, the other thing that I want to talk about as well, which I guess now is as good a time as any, is actually the distribution of people over locations in New Zealand versus Australia. So in Australia, there are 15,353 towns and suburbs in Australia, and the population is about 27.4 million. So that means that on average, there's 1,785 people per town or suburb in Australia. Now, New Zealand's a little different, and it depends on whether you measure localities or whether you measure towns, suburbs, and settlements. They don't have a great. It's a little bit harder to find the exact number in New Zealand. It's somewhere between 700 localities and 2,000 towns, suburbs, and settlements. But let's say it's 2,000, right? Which I think might be a little high because I can only find one data reference from that, and a round number of 2,000 exactly seems a little bit 2,000. Seems a little bit off. It feels like it might be an estimate, but I can't find very good data on it. But New Zealand, let's say that New Zealand's got 2,000 towns and suburbs and localities and settlements and all that kind of stuff. They've got a population of about 5.3 million, which means that on average they have 2,655 people per town, suburb, locality, settlement, whatever you want to call it. If we use the other number of 700 towns, suburbs, and localities, the number shoots up to 7,587. Now, that is versus Australia's average of 1,785. Now, why does this matter? Like, why am I talking about total population divided by total number of towns, suburbs, and town, cities, and suburbs? It's because what you're actually looking at is you're looking at economic distribution among a broader market segment. So if you have a market where there's only, say, 2 cities, right? Let's say New Zealand had only 2 cities, and one had 4 million people in it, and the other one had 1.3 million people in it. Well, then you would see wild swings based on what one of those cities is going to do, right?
Yep.
If you were to take the 5.3 million people in New Zealand and distribute them across 5.3 million towns and suburbs and localities and all of that kind of stuff, you're going to find a much more even distribution of economic of the economy across those or capital across those markets. And that's actually one of the big differences in Australia. It is a much larger market. So when you're typically dealing with smaller cap markets with like smaller float, smaller supply, all of these kind of things, you actually get higher degrees of volatility. And in Australia, we have a greater distribution of the capital and the people across many, many, many more locations. Now, there's huge parts of Australia that aren't populated or all of that kind of stuff, but we still have a broader distribution. And so that has been, I think, one of the things that's helped to kind of smooth things out, because Sydney in and of itself has become very unaffordable. And what we tend to see is that because of the market cap of Sydney, and then secondarily the market cap of Melbourne, what happens in those cities tends to affect the national median house price. But we still have a broad enough market base where there's, 5 major capital cities, really, 5 major capital cities, but then, hundreds of major regional centers with thriving economies that distribute the returns and the gains across those locations. And this is why I wanted to show this table as well, because in this table here, what you can see, so these are the annual growth in median house prices on a quarter by quarter basis. And it goes back to December 2022. If you're on the podcast last week, you would have seen it on there as well. Now, I just want to kind of show you this because I want to point out a couple of things. In the left-hand column, you've got combined capital cities, and that includes Sydney, Melbourne, Adelaide, Brisbane, Perth, Darwin, Hobart, and Canberra. And in the second column, you've got combined regionals, which is all of the rest of the parts of Australia. Now, what you'll notice is that sometimes the combined regionals beat the capitals, and sometimes the capitals beat the regionals. But even in the capitals, what you would see there is, if you look at the September 23 to September 24 quarters, the markets that were outperforming then were not Sydney, and they were not Melbourne, and they were much smaller. We call them the minor majors, right? So that was Perth, Adelaide, and Brisbane. that were actually driving those markets. So Perth, Adelaide, and Brisbane had significant property price appreciation over that period of time, which drove up the combined capital cities market, even though places like Melbourne and Sydney underperformed. Sydney's sort of done okay-ish, like it hasn't tanked, but Melbourne's had a pretty tough time of it because of all the policy decisions that have happened in Victoria as well. So policy decisions make a big difference. And if you imagine that New Zealand is more like Victoria, now, actually, what is the population of Melbourne? It's about 5 million, isn't it? I think it's about 5 million. Do you want to let me quickly
look it up.
What is the population of, not Iran, Melbourne? So the population of Melbourne, Greater Melbourne, is 5.35 million. The population of New Zealand is 5.31, right? So basically the population of Melbourne is the same population as all of New Zealand. So if you imagine, if you just imagine for a second that you were comparing New Zealand with Victoria, okay, and then Melbourne's price declined, right? But a whole bunch of regional centres. So let's say, I don't know, Bendigo, Traralgon, Warrnambool, Bairnsdale. Let's say they all had really great price growth. What would happen if you just looked at the Victorian market is you would say, oh my God, the Victorian property market has crashed because Melbourne's gone bad. Whereas actually the markets could be thriving in many parts of the country. Now, again, this is where the story, this is where I really hate these kind of like property market crash stories, because if we look at going back to the slide that I've got on the screen, so you can see that sometimes capitals beat regionals and sometimes regionals beat capitals. But in Australia, there's 15,353 towns and suburbs as at the last census. And if you can select the right suburbs, you can outperform all of them. And in fact, if you look at the third column there, you will see that the suburbs that Dashdot has selected over those same periods have outperformed in every single quarter. Now, that is not just a shameless plug for Dashdot, although if you do want to work with Dashdot, there is a link in the description below. This is not a shameless plug for Dashdot. This is actually to highlight the fact that there are always going to be some markets that are outperforming. And if you just want to paint the Australian market with one broad brush and the New Zealand market with one broad brush, you're going to miss the nuance and the detail that actually leads to success and prosperity and great returns. Because if we're able to outperform the market, if we look at the June quarter there, our the average performance of Dashdot suburbs over the 12 months up to the June quarter was 20.4% versus combined regionals of 8.2% and combined capitals of 5.1%. Now, that is basically 4 times the combined capitals. In fact, it is 4 times the combined capitals. So we've got 4 times better performance than the combined capital cities just by picking the right locations. And again, this isn't a shameless plug for Dashdot. This is actually just to highlight the fact that if you tar the entire country or an entire region with the same brush, you are going to miss the opportunities, right? And so I actually look at, and as we go back, let me flick back here. Sorry for the jumping around in the slides, but if we go back here to New Zealand, it's been flat for like 2.5 years. That ain't crashing. So what is the media talking about here? And then we go through this again and we go, okay, so some of the bigger locations have declined. Okay, got it. But then plenty of other places have absolutely hooned and gone through the roof. So what are we really talking about here? We're actually talking about a misrepresentation of fact in order to create sensationalist media to scare everyone and to keep everyone on the sidelines. Because what happens to the psychology of property investors in Australia when the media is saying, oh, New Zealand property market crash, what does this mean for Australia? That causes people who should be able to seek out prosperity and fulfillment in and of their own right and their own volition. That causes them to feel fear and sit on the sidelines, and actually robs them of the opportunity to progress. And I think it's criminal, because there's actually no story here. There's actually no story here at all, because the differences between the New Zealand policy and the Australian policy, the differences between the New Zealand market and the Australian market, they're all wildly different. Now, go on, we can get to this later.
just before you get into that, I think your point about the media is so interesting, and this is why I always come back to that stat around. I just looked it up about how much of our wealth is stored in real estate, and so in Australia, the latest stats, it's about 66%, and then in New Zealand it's about 56%, and they're amongst the highest in the world in terms of, out of any country globally, the highest saturation of household wealth being stored in real estate. So that means that we are two countries that are more sensitive to things like policy changes and also media commentary, because we have so much of our wealth is stored in these assets that is so easily tweaked by policy changes that we are so hyper aware that we are glued to media to get any sense of change. And that's what comes through in the headlines. That's why they're so sensationalist, because they know that if they have a narrative of like, this is going to crash, or this is going to boom, or this is, you better watch out for that, they're going to get more eyeballs and they're going to make more money. And it's just, to your point, it's like, it's not ethical the way that they approach it, because we're so hyper like, leveraged is not the right word that I want, but we're so connected to housing as a concept because so much of our wealth is in there.
100% agree with you. And so, the thing about this is there's nothing to worry about. I mean, look at this is the Australian median house price over the last 5 years. Like, sure, it had a little flat period here. Again, on a national median basis, I can show you. In fact, let's just go back to the charts, because we're talking here between 2022 and 2023. Okay, we had a price decline and price flat. So between 2022 and 2023, let's go back to this chart here and say between December 2022 and 2023, 11.3, 10.2, 11, 11.3. Well, I guess there was some places that were getting plenty of growth, right? And the thing is, all of this happened whilst we had the largest rate hikes in a generation. We had huge, rapid rate hikes. And so why has Australia performed so differently? And what's the difference between Australia and New Zealand? And we've spoken about this before, but it's the same. It's the same old story. Demand and supply in Australia is way out of whack. Net overseas migration added 446,000 people in 23-24, and then we've continued to import people into the country to prop up a effectively flagging economy, and that's why we've had a per capita recession. But we're pumping more and more and more people into the country. At the same time, there's been a compound annual growth rate of negative 2.2% in housing building approvals for the last 10 years. Get like, what the hell, right? So we've had a population boom, and then a building approval decline over the same period, which is absolutely crazy. So we've got a huge housing shortfall. We're short by, I worked it out yesterday because I'm working on something else. We are currently short roughly one entire Gold Coast worth of housing right now in Australia. Right, between 300,000 and 400,000. There's I think about 365,000 dwellings in the Gold Coast region, I think, and we're short between 300,000 and 400,000 houses in Australia at the moment. So we're short by one Gold Coast, and then every year we fall behind by one Newcastle. What the hell? And at the same time, in 2024. I might get this figure slightly wrong, but in 2024, we imported one Canberra's worth of people, the same amount of people that live in Canberra. We had a Canberra migrate into Australia, whilst we had a Gold Coast short of houses, and we get behind in houses by one Newcastle every year. How's that?
There you go.
That's crazy. It's crazy. And so in Australia as well, the policy, there's a lot of different policies. We've still got negative gearing, we've still got CGT discount. There's different and more favorable lending policies in Australia, albeit they are still restrictive, but nowhere near the same as New Zealand. So the markets are completely different. And I think that, anyway, I think we've kind of labored that point. So
yeah. When I was looking at that line, like the flat period between like 2022 to 2023, because this is a median chart, that means that 50% had upwards growth, and then 50% had below, because that's a median, so it's the middle.
Yeah,
which is interesting because that's not a sellable story, I guess.
no, yeah.
50% went up. 50%
have you seen that meme? Sometimes I may be good, sometimes I may be shit. You know, it's like, it's like, yeah, like some stuff went up and some stuff went down. Yeah. Cool. Thanks.
Yeah. And New Zealand, from what I understand as well, net migration is not looking good for New Zealand at the moment either, right? Because I think all of this flows in, like, again, going back to 50% of people's wealth, roughly, a little bit more, is stored in housing. So people's sensitivity and consumer confidence is so linked to housing, and that impacts the economy, right? And when things are just feeling shitty, people want to leave. As a that's my general economic thesis. Do you agree with my thesis?
Look, I think sometimes you have the best economic thesis. And just for those of you who are listening, one of Gabby's most famous theses is the Commodore theory of growth, actually. And the Commodore theory of growth has permeated through Dashdot ever since Gabby came up with it. And the theory is that if you are on Google, if you're researching a location and you look on Google Maps, Google Street View and stuff at locations, and you can see Commodores parked on the front lawn, then that is an area primed for growth. That's Gabby's Commodore theory of growth. I'm gonna say it's right plenty of the time. So you know,
thank you for sharing my secrets.
Giving away Dashdot's research secrets. Really, we say that we've got AI, but really what we do is we just cruise around on Google Street View looking for Commodores on front lawns.
Just lives on Street View.
But also just on net migration as well. So over the last 12 months, 46,500 New Zealand citizens moved to Australia. So that was a net negative. That was net. Sorry, that was net, because obviously some Australians moved to New Zealand as well. But net was 46, a drain of 46,500 New Zealanders came to Australia. And that also supports purchasing demand in Australia and decreases purchasing demand in New Zealand. And that's because it's net negative. It's net negative to New Zealand. So yes, some Australians went there, but more New Zealanders came here. And that also brings capital. And so what you end up with is not only net migration, but you also have net capital movements, because people want to move their capital into markets where they can get better returns and better diversity.
Yeah, and this is actually something that came up in the community when we flagged, when we raised this topic, that people are, like, again, going back to consumer confidence, consumer sentiment, people are sitting in that sideways crash in New Zealand thinking that the market's crashing and that they're not seeing any equity growth, particularly from when they bought the asset. Maybe they bought it in 2021 or just prior, comparing it to now, and they're like, well, there are way better opportunities if I just move my capital over there, which I think is really interesting, that's like what everyday people are feeling on the ground.
Yeah, 100%. And so one of the things that I want to point out, though, is relative local affordability and why it matters. Because if we go, sorry, I just did something to my computer. Okay, so if we go back through these charts and we have a look at Auckland, like one of the biggest issues with Auckland was relative local affordability. So debt to income ratios blew out and all of that kind of stuff. And this is what has been a really large driver of people moving out of the majors and into the minors in New Zealand, which is why you've seen regional areas boom, and you've seen the capital cities, which have got the biggest market caps, fall, which has dragged down the average or dragged down the median.
It's very similar to what happened with Melbourne during this period as well. It's like weird policies got put in place and people went, you know what, I don't want to live here. I'm going to move out to the regions. I'm going to move to the coast. I'm going to get a shack. I'm going to do all that kind of stuff.
Yeah.
And that was more like lifestyle as the initial driver, but then the other factors will factor in as well.
It's super interesting, right? Because what you have there is you've got unaffordability is one thing, but if you have unaffordability plus bad policy equals
mass
exodus. People moving, mass exodus, right? And so Sydney has also been experiencing a mass exodus for some period of time. Sydney, however, the prices are still propped up by latent demands. Like it's still got the brand, so people still want to, with all of the net migration and stuff like that, people still want to live in Sydney. But I really wanted to highlight the Sydney price to income ratios and debt to income ratios, because I think it's really, really, really fascinating. And this actually points to, I know if you listen to the start, one of the topics that I wanted to talk about was, potentially why Sydney may not have another boom again. And it's basically because of this. But this is also, it's also related to the New Zealand story. I haven't just wedged it in there because I wanted to talk about it. Kind of did, but it's also related. It's related because this actually explains why people want to move to other parts of the country. And this is actually why, I'm very bullish on Australian property. But as you would have heard, if you go back to some of the previous episodes, what I think we're going to have is we're going to have a rolling boom all around the country where different regional centres are it's going to be like a pan full of popcorn, but there's going to be different markets popping at all different times. And the three drivers are jobs, lifestyle, and relative local affordability. Now, one of the reasons that I think that Sydney has got a cap on its capability to continue to grow, it'll slowly grind up over time. Like, I don't think it's going to crash. That's not what I'm saying at all. But I really struggle to understand how it could possibly grow significantly when you start looking at these numbers. So the typical debt to income ratio that a lender will use is 5 times debt to income ratio. Sometimes they'll do 6, and then occasionally, on very rare occasions, they will do a higher than 6 times debt to income ratio. But there has to be special circumstances for that. So, but if we use 6 as the reference point here, what you can see here in Sydney. So now the reason there's 3 different household incomes in Sydney is because getting the 2025 household income in Sydney is actually a little bit tricky because there hasn't been a 2025 census, right? So it's somewhere between 120 and 160. The best estimate is it's $140,000 household income, not individual income. Household income. So that includes single person households, but also dual income households and all of that kind of stuff. So that is the average household income is about $140,000 across Greater Sydney. Now, the average dwelling price or the median dwelling price in Sydney is about 1.21 million. That includes apartments. If it was just houses, it's like more like 1.5, 1.6 or something like that. But if you look at the average dwelling price across Greater Sydney, it's 1.21 million. So if we look at that, ratio, you can see here, if we use $140,000 average household income, the price to income ratio is 8.64 times, which is pretty wild. But the debt to income ratio at 80% LVR is 6.92x. So you're already over the typical debt to income max, which is about six times debt to income. Yeah. In the debt, if you use 90% LVR, then it goes up to 7.78, which is pretty unlikely you're going to get loans at that. Which means that if you the amount of the percentage deposit that you need to buy with a median to buy the median house price with a DTI of 6 up to 6 is 30.6%, which is crazy, right? Which most people can't afford. And so this actually speaks to the massive affordability crisis in Sydney and why it's going to keep a lid on prices, because the only way that people can get ahead in Sydney is lots of gifts and support and all of this kind of stuff. But dual income households are struggling to actually even get into the market without having 30 or 40% deposits just to get started. And even then, they're going to be racking on huge huge mortgage payments that are just going to be bleeding them dry. And so I think this is an issue, but then that also pushes demand back out to other locations, which again you can find, and then you can outperform the market generally, more broadly.
So how does this show up in New Zealand? Well, I don't think you've got the stats, but it'd be similar.
Let me see if Auckland. I do actually have. Let me see if I do have. I actually did. Let me see if I can find the debt to income ratios for. I have so much. Okay, wait 1 second.
I would make small talk, but you don't do well with multitasking.
No, I don't do well with multitasking. No, I have it here. If you just give me 1 second, I actually do. Yeah, okay. So New Zealand, in Auckland, in June 2024, the price to income ratio was 7.676%. So let me bring that let me bring up the city chart again so I can then read you I'll read you the New Zealand stuff and you can compare it. So the average price year ending June 2024 in New Zealand for a house was 990,000, and the average income was 127,550. Okay, so that puts the price to income ratio at 7.76, which is in between the 140 and 160 band there. The debt to income debt to income ratio at 80% LVR is 6.21x. The debt to income at 90% LVR is 6.99x. And the deposit to keep DTI at 6 or lower at the median house price in Auckland is 22.7%. So the median Auckland household, the median Auckland household with the 20 to 23% deposit sits right on the 6 times debt to income ratio boundary, which is exactly where the policy limits came into place in Auckland. So they put in the speed limits to maximum. Only 20% of owner-occupier loans were allowed to go above 6 times debt to income ratio. So that is, and I have a relationship here. I'm trying to find, I had a ratio here. Yeah. Look, I can't work it out, but anyway, Sydney is a hell of a lot less affordable. There's a specific ratio here. I think it's like 1.4 times less affordable or 1.3 times less affordable. I'd have to dig through. I've got too many notes there. So, you know, what's interesting there though is we're talking again about much smaller markets. We're talking about Auckland. We're talking about effectively comparing Victoria with Melbourne being the main population center and Australia with Sydney being the main population center. It's a much broader market. So, but this is one of the drivers that kind of forced people out of Auckland was the fact that the debt to income speed limits got put in place, where they basically said that we're not going to continue to lend money at higher than 6 times debt to income ratios, and incomes lagged behind and prices were shooting ahead. So basically, people had to move elsewhere to find opportunities.
Yep. Interesting.
Sweet. So, have we answered the question of what does the New Zealand property market crash mean for Australia? By the way, if you've got any questions in the chat, please let us know in the chat. I know we've covered a lot of ground there in a fairly short period of time, actually. If you're listening, if you're here live, do you think that we've covered this enough? Are there questions you've got? Does it actually make sense to you? Because, Gabby, what is your take? Do you think that we've answered the question of what does the New Zealand property market crash mean for Australia?
I'm not sure. I think we've given a lot of insights into like comparing the two. I'm not sure if, particularly as, you know, in New Zealand, they've just started to cut rates. Like I think they've done their first rate cut in like 2 or 3 years. Just 2 days ago that
Australia's
happened.
cutting rates too.
Yeah. And so I think for a lot of people, the headlines over there have been like it's crashing, but I think potentially now it's maybe on the way back up. So is that? Do you?
I think we're talking about two different things. No, I think the property market in New Zealand probably can go up. I don't know.
Yeah.
I'm not going to prognosticate about that. I don't know. You know, I haven't spent heaps of time analyzing the New Zealand market and working out all of the drivers and stuff. I've done that with Australia. Australia's a bigger market. I don't know. I guess so. It kind of looks like it's ready to mean revert to the upside to me. Subject to a whole bunch of other stuff happening. So I guess so. But certainly I don't think there's a crash. So I think let's unpack it. Is there even a New Zealand property market crash? I would say no, because the property market there has been on average flat for the last 2.5 years. So I would not call that a crash. So then if we then say, okay, well, what does that mean? Like, is there even a crash? No. But then also, what does it mean for Australia? Well, it doesn't actually mean anything for Australia. The reason it doesn't mean anything for Australia is because different policy decisions, different market size, different capital distribution, different population distribution has led to more opportunities being more dispersed in more ways. And so if you're investing in Australia, you have way more opportunities to invest successfully in the right locations, right property, right place, right time than you do in New Zealand. And I don't think there's any flow over effect, because if we go back to the start of the episode, one of the conditions we were talking about was like proximity bias and similarity bias. We were like, oh, their market is like ours. Does that mean that it's going to crash here? Well, number one, it hasn't crashed. 2.5 years has been flat. So 2.5 years has been flat. So where's the crash? There is no crash. Yeah, I mean, it came off of the sugar high of COVID and then went flat for like 2.5 years. So there is no crash. And over that same period of time, Australian median house prices gone up in value despite interest rate rises, right? So I would actually say there's no relationship between the two ideas. And actually what it does point to, though, is what can happen if I think it's a great case study of what happens with affordability when property markets get too expensive, because most of this has been driven by jobs, lifestyle, and relative local affordability, right? Which is the main thesis, right? If you look at Wellington, job loss. Lots of public sector job loss. So people have drained out of there looking for new opportunities elsewhere in the country. You look at Auckland, too expensive. People had to go elsewhere because of relative local affordability. So then people have then sought out other opportunities elsewhere in the country. And that's been as a result of A, unaffordability, B, job loss, and C, policy decisions. And so I think it's a great case study to look at that and go, okay, well, how does that then relate to Australia? Okay, well, the similarities are that people are still going to seek out jobs, lifestyle, and relative local affordability. Sydney probably can't continue to, probably isn't going to grow at any great clip at anytime soon, because it's already reached an affordability ceiling. You can't, I mean, there might be jobs and maybe people like the lifestyle. I remember one time you and I drove out. No, I'm not going to go there because I'll upset people in the western suburbs. But I don't know. Some people like living in Sydney, and that's fine. But what it actually points to is people are going to seek other opportunities elsewhere. People are actually going to look for places where they can affordably buy a house with a backyard to raise their kids. They're going to look for opportunities where they can make their money stretch further. Where in relative terms, the housing, the percentage of their income that has to go to housing is lower, which means they have more money to spend on things like good food for their family, good education, good recreation, things they can do with their family, and things they can do with them for themselves, because some people don't have families. So I think it's a great case study in that. And I would say that the only real relationship between the New Zealand property market, in inverted commas, crash, which hasn't actually really transpired, even though you would say, even though there has been a pullback from the peak, is the case study in what happens, or why and how do jobs, lifestyle, and relative local affordability play out to drive different markets in different ways and pull demand out of some locations versus others. So how does that round it out?
Yeah, and my hope is obviously with the Australian government again using what's happened in New Zealand as a case study for policy decisions in Australia, being that because it's such a fine line between trying to maintain affordability for the general population and putting in policies that will bring a boom down, but then not overcorrecting and causing a crash to some degree, which was not necessarily a crash, because it was just
none of the policies that they propose, which will bring prices down, will actually bring prices down. They'll actually distort demand and push prices up. There's not a single policy proposal that they've put forward to fix the problem that would actually make prices go down. All that would happen is there's a couple of really great case studies of this. So if you look at, they put in rent controls in Ireland, and they said you can only charge a certain amount of rent.
Yeah.
And so all of the landlords said, well, fuck this, we're selling, and they sold all their properties. And so then the available properties to rent diminished massively, and there was literally queues of hundreds and hundreds and hundreds of people trying to rent properties. We already have that in Australia. So if you start to put in policy decisions that are actually going to make, because there's a free market dynamic, and real estate investors make up a portion of that dynamic. Typically, it's about 33% on average, right? And that may change a little bit from time to time. So roughly 33% of the market is taken up by property investors who provide rental accommodation for people who can't afford to buy properties. If you take that out of the market, so let's say you click your fingers overnight. Let's say overnight you said, bang, no more property investors, right? Tomorrow, 100% of property investors have to sell all of their properties. Let's say you did something like that. Now, what you would broadly assume would happen is that prices would come down by about 33%, right? Let's just say that, right? If you increase the supply, prices may come down by about 33%, except for the fact that demand would be soaked up almost instantly by people who want to get into the market. So as the price came down, the demand would rise to meet the price, and it wouldn't come down by 33%. In fact, it may not come down at all. It may come down only by say 10%. But what would happen is you would also take out all of the rental stock in the market. So some people would get the opportunity to buy a house, but a lot of people would be left homeless, and you actually end up in a really bad position. And so it just doesn't work. Any of the policies that they've got, the only policy that solves any of this is build more houses, and they haven't got a policy for that. They haven't got shit for that, right? So that's the only real solution is build more houses And by the way, if they did that intelligently, then that could stimulate real GDP growth rather than artificial GDP growth. They could actually stimulate like a per capita GDP growth, not headline GDP growth and per capita recession. And so I don't think there's a single thing that I've seen being put forward that actually solves solves any of this, which is also why I'm super long-term bullish on Australian property.
Yeah, this is what I mean by using New Zealand as a case study, because they put a lot of the policies that New Zealand put in were very anti-property investment. And then the steep, steady downturn happened over a few years. And that's because investors went, I'm not being incentivized to provide housing in this market anymore, and so I'm going to move my capital elsewhere or not do anything at all.
Yeah.
But like one of the policies was, I think they completely scrapped being able to claim interest on mortgages for investment properties. And that you can imagine that happening, similar to like scrapping negative gearing in Australia. You can imagine that happening. Investors just go, what, there are other things I can invest in, or just not move my money around, which is not good for the economy. Like, these things happened in New Zealand, and I see that now. Hopefully Australia is not going to make similar mistakes where they put in all of these policies to deter investors, when that's not going to be good for housing.
Yeah, I hope so too. I mentioned there was 2 great case studies earlier. The other one that I really love is Argentina. So in Argentina, they had a housing crisis for years. They had a housing crisis, and so the government said, okay, we're going to put rental caps on to make sure that housing stays affordable. Except what happened was that all of the landlords sold all their properties. They're like, screw this, and so then there was no available properties, and so they had a real crisis. Then when Javier Milei came into power, he just said, look, he's a free market absolutist. And look, I'm not going to take a position that I think is, I don't know. Like I see some of the stuff that he's doing and I'm like, wow, that's cool. But I'm not in a position to say that I'm a Javier Milei acolyte or anything like that. But he basically said, no, the free market prevails, take it all away. And within, I want to say like 6 months or something like that, they'd pretty much solved the housing crisis. Like they pretty much solved the housing crisis. Like homelessness went down, rental prices went down, rental property availability went up. Like so, it basically solved like this huge social problem just by saying, let the free market work it out. Yeah. And so I think that what we need is, exactly. What we need is less government, less regulation, and let the free market work it out. So. And hopefully that's what we can learn as well from the situation in New Zealand, where they tried to overregulate it and ended up creating a real bun fight. So,
I just wanted to bring up, because Sandeep's dropped a good question in here, and it's actually related to something that Braden put in the community. It was basically just like as related to New Zealand. Should we buy the dip? How do we buy the dip over there? Is a question that's come up. I'm thinking we've covered that to a large degree. Largely, like, we don't have expertise in that market. And also, what dip?
Well, so I'd probably look at it from a couple of different lenses. So number one, not the right person to give that advice, because we don't. New Zealand market's not our area of expertise. It's not our area of expertise. Number two, I wouldn't be looking there.
Yeah,
I wouldn't be looking there because it is a smaller. It's like. Look, I think there's more.
Well, compared to Melbourne, right?
Yeah. There's more. Well, the thing is, Victoria. Like, I was about to do that. I was about to compare it to Victoria, but in Victoria, there's some great opportunities right now because it has been depressed and prices have gone down, and in certain places, right? So if you used Victoria as a corollary, and if you just thought of New Zealand as an additional state of Australia, then you might say, okay, well, maybe there's some space over there to invest. The thing is, you would have to ask yourself, like, how would you make an appropriate investment decision? Now we've spent $6.5 million now on building technology and systems to make sure that we can find the right property in the right place at the right time. I wouldn't want to walk away from a proven system that delivers radically outsized returns to take a punt off probably gut feel and subpar data in another market just because I thought there might be some kind of price arbitrage opportunity. It feels to me a little too speculative. Now, all investment is speculation to some degree, but obviously what we've tried to do at Dashdot is to remove a lot of that speculation and to try and get to a place where we can have a high degree of confidence that it's going to be the right choice. And, we've bought over $1.3 billion worth of real estate now, over nearly 2,300 properties successfully. So something's working. I don't know that I would want to, given the amount of capital required to invest in real estate, I'm not sure that's where I'd want to have a punt and have a flutter. And that's not how I would think about it. Do I think that in aggregate there's probably a mean reversion? Sure, but as we pointed out, some of the markets are already growing pretty rapidly anyway. So unless you're saying that, on the median basis, there's an opportunity for mean reversion, and Auckland is the biggest influencing factor on the median. Therefore, if I was to, in inverted commas, buy the dip, I should seek to buy in Auckland so that I could pick up that trend reversal potentially in Auckland. You'd have to validate whether that's a good idea. You'd have to work out where in Auckland you'd want to buy a property. What type of property? How would you work that out? And the property prices in Auckland are pretty expensive. This
is the thing. I think people might be thinking. I think people might be thinking it's more affordable. So, if there's a dip opportunity over there and it is more affordable than the Australian market, then should I try and buy the dip? But I don't know if that's. Without the right data. Yeah,
exactly. And the affordable markets are also the markets that have been growing quite a lot as well. And again, I can't say that as a blanket statement across the board, but it appears that way. And the reason I can't say that as a blanket statement across the board is because we're not New Zealand property market experts, so we don't really know. But Sandeep, my advice to you would be to question why you're looking to buy New Zealand, and actually ask yourself whether you can find better opportunities in Australia or not. So that would be my advice.
Great. Cool. Nice.
I think we covered it.
Nice to hang out with you.
I will see you in the other room. Really. Guys, thanks for joining us. And a reminder, if you want to join us in the community, there is a link in the description. Also, if you think this is useful for someone, share it with them. Give us a like, give us a subscribe on whatever platform you are on. It helps us to know which episodes work. We actually see really how many shares we get and how many likes we get and how many comments we get. That actually gives us an indicator of what's working and what's not. We made a commitment when we started doing this again at the start of the year that we would only talk about things that we actually want to talk about, but we also want to know what you guys want to know as well. Because if those two things can collide, things that we're interested in and things that you're interested in, then we can create great content, and we can do that with you. So we can do that as a community. And again, you can have your say in the community, the Investor Lab community, and you can join in the show notes. And of course, if you want help to successfully invest in the Australian property market, then of course, work with Dashdot. We're the best in the business, and there is a link in the description as well. You can check that out. That's all for now. See you next week.
Bye.
Bye.